Good morning, everybody, and welcome back to today's episode of Derek Invests. I'm your host, Derek Miller. What we're going to talk about today, we're going to talk about the recent price drop in indexes, how you evaluate those price drops. So there's three components to any drop in price that are going to give you a good idea of how far price should drop, okay? How extreme the drop should be, and then is it going to turn into something else? Those three components are volume, price, and gaps on the chart. Gaps specifically when you're dealing with an index, but that can roll right into individual stocks as well. And to do that, what you have to understand is the construct of the stock market itself and how it works. And I'm not going to go on and on about this, but you have to understand one thing. Institutional buyers and sellers, if they are looking to buy more of something, they want to institute fear as quickly as possible in the retail, the less knowledgeable hands of the stock market, so they can buy up more stock and take us to a higher price. When they are looking to distribute and actually do a longer term sell, it will take more time. They'll sell a little bit, price will drop, then they'll allow it to pick back up, then they'll sell a little bit and a little bit and a little bit and a little bit and a little bit. So if you understand the idea of wanting to buy more by creating fear with precipitous drops, and if you understand that if you want to sell off, you want to sell at the highest price for the longest time that you possibly can, if you run off of that baseline knowledge, then you can have an idea of what you're looking at when you go through something like what we're going through this week. Now, you have to realize that price drops can pick up steam, and they can pick up steam for several reasons. One can be that the trend followers jump on it and they start writing it down. Another can be that retail, actually, that fear does get instituted and they do sell out. Initially, what will happen is retail will go right to the buy more, buy the dip mentality. So your first spike in volume, which is your first highly active day or 4 hour or 1 hour or 5 minute, whatever scale chart you're looking at, that first big spike is that buy the dip mentality. Okay. And what you have to do is evaluate it after that. So we're going to evaluate the price drop of this week. And then we're going to talk about the three pillars of making any investment or trade, which is risk management, cash management, and investment management. Okay. You should know what those three pillars are and how to utilize them, but they work in tandem with your price, your volume, and your gaps. So let's just get into it a little bit about what has happened this week and what we can see coming and how we can forecast what's coming a bit. And then we could say, okay, here's what I should do. Here's what I should do. Here's what I should do. Everybody's very different, but the point of these videos, I think I have put enough out there that my forecasting and my accuracy rate is high enough that if you don't realize I know what I'm doing, you should tune out now, or just go through my Twitter feed. All right. Now, to some degree, I suppose that can be hard if you're really just think you're going in there and don't worry about it. Listen, my accuracy is there. I put up charts with dates. I put target dates. I put target prices. Right now, my accuracy rate on every chart I'm putting up is around 80 to 85%. I do longer term charts. I do intermediate term charts. I do short term charts. I can change that time frame because the methodology that I utilize is the methodology utilized by every trader known to man for the last 100 years, and you keep it really basic. I don't look at RSI. I'll look at relative strength, but I will generate the relative strength. I don't look at lagging indicators. I don't look at RSI. I don't look at moving averages. I don't look at Bollinger Bands. I don't look at Fibonacci. I don't look at any of that. And the reason is all that stuff looks backwards and it's easily disproven as much as it's proven. Good day traders might have that stuff on their chart to verify what they already know, but the likelihood that they're using that on a day-to-day basis and they're successful is very small. You'll be successful 80% of the time because that 80% of the time, the market's moving in an upward trend. But when a bear hits or when a swift market pullback hits, you'll give all your gains back because you'll just keep buying. You have no idea when it's going to stop. You'll just keep expanding your Fibonacci's to longer term time frames, and you'll just give all your money back. And if you're doing that and you know you're doing it, you need to contact me and ask me about what I do and how I do it, because that's going to continue to happen to you until you understand why and how a market moves the way it does, which is what today's lesson is going to be on. Today's going to be more about showing you what to do rather than when it's going to happen and how it's going to happen, and just giving you these price points, which I do almost every day of the week. So let's get over and take a look now. Here we are. Okay, so this is the NASDAQ right now. I believe it opened up about a percent. Now it is up 60 bips or so, okay? Why are we so interested in volume? Let's talk about the three pillars first. Why are we so interested in volume? Well, one, it's trading activity. That is the footprints of institutional money. Trading activity is the footprints of institutional money. I don't need to repeat that again. There's only one group of people that can generate ridiculously elevated levels of volume in any index in the world, and that is institutional money. Now, I want to show you something. You see this stuff at the bottom? This is your volume. For those of you that don't know, or maybe you're new to this, this is your volume. This was boop, 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 yesterday, okay? Or this was Wednesday, as a matter of fact. Yeah, was that volume on Wednesday? Yeah, that volume's on Wednesday. Now I want to show you something. That is the top of the volume. That's how high it was on Wednesday. I'm going to put this in red. Okay, there we go. So that's how high volume was on Wednesday. Now look at this, and you tell me if that's an outlier as far as volume goes. Most definitely it is. And that outlier has come on a price drop, so a precipitous price fall. Now, if we go through and we evaluate volume on this chart, this is a 30-minute chart, and we're looking for average volume, notional now. Just what is the average volume here? Probably somewhere about there. Now, what you're going to notice, and what anyone should notice, because again, you're just using your eyes. This isn't, you're not trying to figure, you're not sitting here doing math on how much more volume, what percentage more volume is it? This big giant bar here, I don't know, 3 or 4 times more volume, right? You have one of these back in June. Now, the difference is it's after a price fall, and it's pushing price back to almost the level it dropped from. That's this bar right here. All right. And see that dotted line? That's how high it was on June, or maybe that's May. Yeah, that's May 31st. Okay. But it's pushing price almost back up to that what was support. So what was support here would be here. It's pushing it back. It got it back to that level. All right. So that tells you that's that buy the dip mentality that takes place. Now, what we notice now as we look back here, these bars are all relatively low. They're close to average, right? Some of them are maybe 100% higher. And this is getting you all the way back into May, by the way, the beginning of May 3rd. All right. But what you see here, what you see in this block, it doesn't look like that at all, right? I would say if you were saying what's the average volume here, it's increased significantly, probably double, maybe triple. This started, I would say, probably right here on July 11th. Okay. Now, so what we see now is we see big volume. We see a lot of trading activity. So we see a footprint of institutions. Now, what we want to know, institutions, if they are selling to get us into a real correction, they're going to drip sell. They're going to sell real slowly to keep price elevated for a time period. They want to keep it up there so they can sell as much as they can at the highest price possible. If they're looking to institute fear, they're going to drop price precipitously. Bang, 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 bang. Because, and then everybody out there that thinks they know what they think they know what they're doing, but don't. And they get scared easily and quickly because they don't really understand what's going on. And by the way, that's how emotions are evoked in anybody. When you don't know how things work, when you don't understand, how things happen, you get scared because now it is something that you can't define. So when we look at this and we look at how prices dropped, and this starts on, let's just say the absolute high would have been July 11th, interestingly enough. As price drops, did it drop slow or fast? So from July, this is actually July 11th, from July 11th until today, the 25th, so 2 full weeks, about 10 trading days, has price dropped fast or slow? I would say very fast. Okay. This is a very fast drop. You're sitting up here at 504 a couple of weeks ago. Now you're down to 456. You've dropped 10%. You've dropped 10% in 2 weeks. This is a fast price drop. And it's eating a lot of people up because they don't know what to do. They're just trading on moving averages and Fibonacci and so on and so forth. So what do we know? Well, okay, so price dropped very fast. It's dropped on high volume. So we have institutional players that have created the price drop. The price drop is very fast, so obviously intentional. So we know there's supposed to be an emotion here. We know we've had to buy the dip mentality, which institutions are well aware of too. I think everyone in the world is well aware that everybody thinks the market's just going to go up, up, and up when that is not how a market works. So what would they do? If you knew all that and you were somebody trading against that person, what would you do? Well, you would drop it. And as they invoked their buy the dip mentality, then you'd really hammer them. Then you really sock it to them because now the real fear sinks in because now they go, what the heck was that? I thought all we had to do was buy. I thought every time it dipped, we just buy. Well, now that's not the case, is it? That's not what you do, because if you just buy, what happens? Well, there's three pillars that you have to follow: cash management, risk management, and investment management. Now, on a cash management front, you've probably blown your wad, so to speak, by now, meaning you've thrown all the dice you have at the table. You see a 3 or 4 or 5% pull down, and you're used to just buying a dip. You're going to throw a lot at it, probably most of the cash that you have. Let's be fair and honest here, everybody. You're going to throw most of your cash. That's a ginormous mistake. And why is that a mistake? Well, because if you understand that price was dropped precipitously and quickly in order to invoke a response, which is why this gap exists, what's the easiest way to move price down, folks? Or up, for that matter? If you don't have the steam to do it, if you don't have the sellers or buyers to make something happen, what do? Gap it. Gap it. That'll invoke some selling. And then when some selling occurs, people are going to start going, oh, buying opportunity. Everything's a buying opportunity, right? So they come and they buy. And that is why on the way down. So here's your first price drop. Look at that. Volume came way up here where this dotted line is, just on a nothing pullback from 505 to 492, 2%. Look how many people started buying. Hold on. Let's get to make it accurate. On the dotted line, look at that. Everyone starts buying that at that rate on a 2% pullback. It comes back up, and then here you go. You gap down. Whoa, look at volume there. Boom. So you know how many buyers there were at the open on that day because it gapped down that way? A lot of buyers on the open. And then here's some more volume, right? Now, volume is starting to dry up. And what you get is a little bounce. Volume dries up again. Why? Because there are no actual institutional buyers at this level. So what do you do now? You gap that son of a buck again. Look at this. How do you generate more fear? Now, let me show you something. As the price drops down further, what do you get? You get this massive amount of volume. This is people that were buying here and here, selling because they have no idea what's going on. Now they're starting to panic. Now we're down 7 and 8%. In fact, we're about down 10% as we speak, right? So we're down 10%. Oh my gosh. Now they start to sell. In a longer term time frame, if we were looking at a daily chart or a weekly chart, and you were looking at 08 and 09, this would be your capitulation bar. This would be technically capitulation. Then what should happen is one of two things. If we're starting a new trend to a downward direction, and this is where I love Elliott Wave. I don't follow Elliott Wave as a forecasting mechanism, but it's a great way to determine which way trend is going and if trend's reversing. If it's moving in a 5-wave pattern and it has flow, wave 3 being the strongest wave, right? So wave 1 is in trend, wave 3 is in trend, the strongest wave, and then wave 5 is in trend. It should be your weakest wave, and it should reach either the lowest price point if it's a trend down or the highest price point if it's a trend up. That Elliott Wave will give you flow. And if you know anything about Elliott Wave, and you know wave 3 is the strongest, you also know it's the longest. And it always carries two gaps, a gap in wave 1 and a gap in wave 3. And wave 5 will go lower than wave 3. And it's a great way to determine trend. I can tell you right now, when you look at this 1, 2, and this being 3, this would be a gap in your wave 1. You got to bounce. This is your wave 2. Now you have a 3, a 3, 4. and you should have your 5. We should reach a new low before we begin to rally at this point. Now, I had put a forecast out on Monday. I thought when this gap pulled down, when we had this initial gap, I go, oh, it should be back there by next week, which would be Tuesday. I said, oh, we'll be back at 490 by Tuesday on the NASDAQ. Now, if you look at that forecast alone and you don't know what you're doing, then you don't realize that, hey, it can pick up momentum. You will fill the 490 gap, but now you are extended. So this gets us into, now we've evaluated, how do we know if a price drop is going to become something bigger, or if it was used to invoke a level of fear so that institutions could simply pick up more shares. This, to me, looks like an example of institutions invoking fear to pick up more shares, period. I'm leaving it right at that. This does not look like a trend change to me at all. Now, if this is me, and because of who I am, on this initial price drop, let's just say I was, okay, back up. We also know one other thing, regardless of what type of price drop this is, you will always have a second chance. It will always return from the level that it broke out from. So it broke, was previous resistance back here. See back here, these 2 points? This is your previous resistance. It broke out. It had to retest. It failed to retest, okay? So now your support level is up here at that 490. You will always have a second chance at 490. Now, how close do you want to play it to that 490? So on a bounce, you should have a chance at 490. It depends how greedy you are. Me, I am not all that greedy. So what I would probably be fine with is about 488.50 on a bounce. But I bought, right? So this came down, and I said what I would have waited for. I'll tell you exactly what I would have bought. I have no problem with it because for me, it wouldn't be a mistake. I build 10% positions initially. So what I would be doing on the way down is building a 10% position. Upon the bounce, I would scale out 5%. And when I got back up here, I would build another 5%. I would build on my position. I would have sold half the fall, right? And then here's what would happen. If it broke through this support level and got to 500, so from 488.50 to 500, I'd close out the position. However, if it did not, I would build back 5% more on the next price drop because that would indicate a trend change. If I'm moving fast, I apologize. I don't want this video to go beyond 30 minutes. So for me, my risk management is I'm building a 10% position on the way down. I can tell you right now, this is where let me make sure I'm being accurate here. I would have not bought here on this initial drop. No, not a chance. I would have waited for a bounce, which I didn't really get. So probably as it came back in, this is where I would have started buying again, which would be July 18th. It would have been somewhere in this price level here, which is about 476.50 on this bounce right here. I would have been building to the downside without a doubt. I would have been building to the downside. I'd have probably, because we were of this buy the dip mentality, when we didn't get a bounce, I would have definitely been building into the position here, scaling in. Right now, I can tell you that I would call this a wave 3. I would have already sold off half of the drop at this point, without a doubt. I would have sold off half. So if I did get to 10%, which in this drop I would have, for me, about every percent drop I get on an index, especially the NASDAQ, because the NASDAQ has bigger drops, every percent I get in drop, I'll usually add 2% to a position. That's me, okay? So if the NASDAQ were to drop 5% from this initial fall, I would probably already be 10% in, all right? Why? Because I understand gaps. Gaps are nothing but price targets. So I know 490 is in play. So for me, the further it falls, the more I like it. I will tell you that I don't wait for bottoms. I believe it should break this, what is this level? 455.90. I believe it should break this, okay? I would say it should probably come into like, I don't know. Here you go, 452.50 probably. But I'll tell you right now, I won't wait for that. So as this drops, I would already be sitting in a 5% position right here because this is capitulation. This is traders and retail that didn't understand what was going to happen, selling without a doubt. That created this little bounce. Institutions are going to come back down. They're going to check for supply. How much volume is down there? Are there still guys holding stock that we can buy? Can we pick up more shares? So what I'm going to look for now is volume to drop. If it gets if it gets down to this average volume level down here, this bottom red line, then I would pick back up 5%, but for the rise. Now, how funny is that? I'd have 5 short at that point, and I'd have 5 long at that point. I'm in a neutral state because what's going to happen is I'm not going to buy into the fact that this is a rally yet, right? But I know we're going back to 490. And this would be for an intermediate term kind of swing traders, the way they would trade. This would be intermediate term. If you're day trading, it would be different than this. Most of the people that work with me are intermediate term and long term. Day trading right now, this would be the funnest game in town. I would be having a ball. I am having a ball, as a matter of fact. In any case, so I would be 5% long once if volume dries up and it breaks to a new low. And when I say breaks to a new low, if it hits 454, I know there's another 1.5 that's probably likely. I'm taking it. I'm going 5% in long. Once it fills this gap, it'll have another pull down. So I would sell off the short position. As it pulls off this gap, I would sell another 2.5 of the short position, let the long run, or put 2.5 in, depending how well it trades. Then as it comes up and fills this gap, it's going to get some pull down again. Once it pulls down again, now it looks to me like this is going to be a trend change. So I would eliminate the short altogether. Would my short trade be profitable? Extremely profitable. And now I have a long running. And so I either have 5 or 7.5% sitting in my long at this point. As it rallies through, when it gets here, I'm going to sell off half my long. It should pull back. I'm going to do nothing. It's going to rise to a new price. I'm going to wait for the retest of previous resistance, would be right here at 503. Okay. Now, I hope this made sense to you. Your gaps are used as price targets. And you need to remember something. A gap is like driving down the highway. The further so your exit's back there at exit 57. The further you get away from exit 57, the more dramatic you're going to have to get back to. So if you get to exit 60 and you only have 3 minutes to get back to exit 57, whether you turn around at exit 58, exit 59, or exit 60, you only have 3 minutes to get back to exit 57, period. So if you only have 3 minutes, the further I get away, the sharper my U-turn and my drive back is going to have to be. Okay. The closer, the longer it takes. So do I get concerned when a gap doesn't fill immediately? Absolutely not. It just means that it's going to have to be a sharp U-turn and a fast move. And this also helps you evaluate the market itself. See the gap back here? I'm going to have to jump off here. And I hope this lesson was informative. And I'm going to follow up on this lesson. I'm going to do a little series over the weekend. See these gaps? Guess what? They're filled now. How dramatic was the U-turn and the drive back? It took 10 days. It took you from June 4th until, July 11th? June 4th to July 11th. It took 5 weeks. It took 5 weeks to get here. It took 2 weeks to return. There you go. That's my point. Okay, I'm going to stop the share here. Look, guys, I hope this lesson taught you something. That was the point of this lesson. And remember, if you're not good up here, you're not good anywhere. Okay? Get outside, smile, see the sun. Fake it till you make it if you're having a bad day, all right? Bad days turn around. You haven't failed yet. You're batting 1,000. I believe in you. I'm rooting for you. If you're interested in the lesson I just taught right now, that's just the tiniest piece of the masterclass and the one-on-ones that I do to help folks accurately forecast their trading and investing, whether it's extremely short-term, intermediate-term, long-term, doesn't matter. This transcends those things, okay? Remember, every day above ground is a good day. Thank you all so much for joining me. I hope you enjoyed that, and I will see you next time.